Once again, ladies and gentlemen, this is the Investor Show. As always, this is your host, the Prince of Investing, Prince Dykes, coming live all the way from the beautiful state of Denver, Colorado. Don't forget to hit that like, subscribe, comment, and share button. And also, don't forget to drop some comments if you got questions below. And follow our description box in the link. And, check us out on Facebook, Instagram. We do a little bit of Twittering, all of the good stuff like that. And the podcast is all of the great stuff that drops every single week. But as always, I don't have a lot of time, and I definitely know you guys don't have a lot of time. Let's get straight to it. So anyway, this video, as you guys can see, this is going to be me talking about Betterment. Betterment is a robo-investor kind of a platform. I've seen a lot of people in my comments and inboxing me saying, hey, I got in Betterment, better way of investing, other good stuff like that. Hey, what do you think about it? Can you talk about it? So in this video, I went and set up a Betterment account, and I'm going to tell you guys what I think about it. I'm going to hit you guys with facts and my way of looking at things, and just give my opinion. So let's jump straight into it. So here's my Betterment account. I went and set up one today, and it pretty much says that I should be 90% stocks, 10% bonds. Not bad. A little aggressive, and it's slowly saying that it's going to become more aggressive over time. And here it's saying your 1 year return. The downside is a negative 15, upside is a negative 13. It's pretty much kind of tracking the stock market, right? Average return of plus 6%. I don't want an average return of plus 6% because what is the average return of the S&P 500? Who knows that? Don't worry about it. I got it pulled up. You can just type into Google here that says S&P 500 index average return, and it's going to tell you the average annualized total return for the S&P 500 index over the past 90 years is 9.8%. Right here, that's not me. That's 9.8% of a CNBC, right? So the first thing I'm looking at is why would I settle for under market performance? But that's because it's putting 10% of my money in the stocks. But even if I slide it over here to the right and put 100% of my money in the stocks, it's saying that this is too aggressive, but it's saying that I'm going to get a plus 7%. But, that's great. That's not a bad thing. Now my thing is, what am I going to be holding in? What are the holdings? So this is telling me, hey, we're going to put you in large cap, small cap, little international development, some U.S. value stocks, U.S. stock market, whatever. Coming out to be a total of fees of 0.07. Not bad at all. Definitely better than your traditional, investment advisor. It's not a bad return. I meant to say expense. But we all know that I can track the S&P 500 for as little as 0.03%. That is like someone who's paying 7 cents every year, versus someone who's paying 3%. That's almost double in fees of what you can get with a low-cost index fund. If you don't know what that low-cost index fund is, you can DM me or comment me and get that. But if you follow this channel, you should know what I'm referring to. So now it's saying, hey, we can track the stock market for you for 0.07. I can do that with an index fund. And when you go over here to Betterment, you go over click and it says, why my will my Betterment portfolio beat the stock market? And it's clearly telling you here, right? We can read it together. Betterment portfolio is designed to keep up with the market and not underperform, but it is not designed to beat the market. Beating the market is difficult to do with uncertainty and involves a lot of risk. So it's clearly telling me right here, hey, we are not trying to beat the market. We definitely are not trying to underperform it. We're just going to keep you right in the market. Great. Betterment is a strong believer in passive investing. The majority of evidence, right here, the majority of evidence shows that active management, whether by individual investors or fund managers, cause more harm than good in net of fee returns. We therefore invest in low-cost passive investments which always seeks to match market performance. In bold words, their goal is to match the market performance. You will never You will never outperform or beat the market on a risk-adjusted basis in your Betterment portfolio. So they're saying you would never outperform the market. Their goal is to match the market. So great. That's a great idea, great philosophy that you're at least trying to match the market. But I can match the market with a low-cost index fund for half the fees. You can do the exact same thing for half the fees. So I don't get it here. I mean, yes, you can adjust it. You can add in bond ETFs, but when you're looking at this, if you're looking to match the market, you can go out there and get a low-cost index fund that is half the fees of 0.07, which I know one right now is 0.03, and get the same return. And you're going to make even more money because you are keeping more money in your pocket instead of paying an individual performer. Now, I'm not saying Betterment is bad. Betterment is they're a great company. They have a great philosophy. They are, it costs money. This website costs money. Their research costs money. So, hey, they have to make money. So, if you have a Betterment account, I'm not saying that it's bad. It's good, It's way below the industry. They have a good objective of matching the market. They're not trying to promise you anything crazy. But in the financial world, what have you guys always heard me say? There's good, better, and best. Good, better, and best. They're good. Is it something better? It probably is. I'm not believing that this is the best from my clear observation. So anyway, that's my thought process. That's my quick synopsis of Betterment. I know they have all these type of asset allocation where you can put money here, diversify your portfolio, whatever the case may be. But if you're a young woman or female, majority of the people that show that are, you should be pretty aggressive in your funds. And you should only have kind of bond, at this point in life. I mean, it doesn't. Everybody's life is different, but generally speaking, you should be a little bit aggressive. You should be trying to get all this bull market because you can absorb losses right now and rebound. There will be another market decline, and when it happens, you'll still be in your young investing ages to take advantage of the decline. So anyway, don't forget to hit the like, subscribe, comment, and share button. If you think I'm an idiot or a moron, or if you think I'm right, drop a comment below and let's talk about it. Until next video, podcast, cartoon, book, or whatever else you see me do crazy around the globe, peace, be safe, I'm out, and thank you. Don't forget to check out the Western Learn series. Peace.